Well, today was a historic day in American monetary history, something that economists will be debating, I'm certain, for the next 100 years and perhaps even longer than that. And it was the launch by the Federal Reserve of QE infinity. And I'm not joking this time. People have made the QE infinity joke before, saying that about not QE, and then okay, well we have this official QE4 thing that's coming out. Of course, they're not calling it QE, not at all. I guess 'cause QE has a bad name now, but it is QE infinity because the Fed came out and they said, we're going to do whatever it takes. We're going to, supply as much money as is needed, and we will purchase as many bonds of any kind. Okay, so that's U.S. Treasury bonds, which historically is all the Fed has ever been able to buy until 2008 when they started buying mortgage-backed securities, I believe. So U.S. Treasury bonds, federal government bonds, mortgage-backed securities, commercial paper, which they just unveiled, not too long ago. Now commercial bonds, including, I believe, commercial bond ETFs, which the Fed has never bought any kinds of ETFs, at all. And then municipal bonds. Now, obviously, we're just one level now removed. The only thing more that the Fed can do is directly purchase stocks or stock ETFs. And I'm a little confused because in their paper that they put out last week about their new special vehicle that they had, before this QE Infinity announcement, which again, I will get into that in a second because again, limitless money being injected into the market can't overstate the importance of that. But last week in this special vehicle they set up to try and help out the primary dealers, they said that they would be buying, that they could take equity securities as collateral. But I'm not enough of an expert on how the plumbing of the Federal Reserve actually works to understand why people aren't taking that to be as serious, as I did when I read that. Because, very serious people are still acting as if the Fed, cannot directly purchase stocks. Maybe what they mean is that the Fed can't literally go out into the open market, in open market operations, maybe, and buy stocks. Maybe that's what people are referring to. But anyway, either way, I don't think it really matters. That's splitting hairs at this point. That's getting into way too detailed because either way, what the Fed is doing is obviously meant to juice the stock market, and it will have that effect, or at least it should, on to some extent. All else equal, it will have an effect. It might not necessarily push stocks green, and it certainly couldn't today. Today, stocks were green for a few minutes after the Fed announces, which, by the way, this is an absolute bazooka. QE infinity. Nobody would have ever predicted this in 2008, except for people like Peter Schiff, or possibly people like I'm not shocked by this at all. But this should be shocking to most people on Wall Street, considering that they all thought that the Fed was in control and that the QE is in a very extreme, very potent measure. Obviously, QE is not very potent if they have to say that we'll do whatever it takes, and they can't even set a specific number. And so what we have here really is the Fed opening the door to modern monetary theory, also known as magic money tree, money printing, debt monetization, call it whatever you want. It's a very old, a currency debasement. That's probably the oldest term for it. Back when kings in Europe would melt down their coins and then mix in some tin, I think, with their gold coins and thin them out so that they weren't pure gold, and then put those coins back in circulation, making more money, making more coins from the same amount of gold. That's kind of the same thing we have going on here. It is literally the Fed coming out and saying we are going to purchase the entire bond market if necessary, even if we're the only buyer of all bonds of any kind. We will support the bond market and make sure that yields never rise, that there is absolutely no market for bonds. Sure, other people can compete with us and buy bonds if they want, but we're going to make sure that we fix the price of bonds and that bonds never go down and that the bondholders, never have to take a haircut. Now, of course, that doesn't mean that there aren't consequences to the Fed's actions here. Because if the bondholders aren't taking a haircut, somebody else must. And that would be, the rest of America, the folks who are not the bondholders, the folks who don't own bonds. Actually, just as an interesting side note, I have some family members, older people, who, by the way, those are the kinds of people who tend to buy bonds, older folks who want more secure, fixed income investments. who owned quite a bit of bonds, and I encouraged them to try and get out of those positions, over the last year, because I'm a fairly apocalyptic person when it comes to the economy, and they didn't. Of course, they lost a lot of money because bonds have gone down in value substantially. Because, as I've said in previous videos, that with as soon as these companies that own, that issue these bonds, and of course by extension the municipalities and other entities that issue bonds, are really sensitive to cash flow. They need essentially perfect conditions to be able to continue to meet their obligations to their bondholders. They're completely levered up. They can just barely service their debt. So if there's any sort of a hiccup in their cash flow, then they end up defaulting. And that's what we would see right now if the Fed wasn't coming in to bail out the entire bond market. Now let's get into how this affects stocks. This will have a direct impact or an indirect impact on stocks, because by buying up all the bonds in the market and making it possible for companies to continue to issue as many bonds as they ever will, this is the Fed giving a blank check to corporate America, to the U.S. government, to I guess the lenders too, the mortgage industry, because of course they buy mortgage-backed securities. They pretty much are telling them, hey, issue as many loans as you want, and we'll continue to help you inflate a housing bubble. But anyway, back to corporate America. By buying up all of corporate America's debt and making sure that their interest rates never rise, what the Fed enables the corporations to do is to not only invest, that money that they borrow back into their businesses to, grow their business and try and make more money, which they do that with some of the money, but for the most part they issue bonds to buy back stock. And so if we look since 2008, who the major buyer in the stock market has been, who's been driving the prices of stocks so much higher, it's been corporations issuing bonds to buy back their own stock, issuing bonds at absurdly low interest rates, I should add, which allows them to lever up incredibly high, to have an immense amount of bonds and still barely be able to, service that debt because the interest rate is so low. And so what the Fed is doing here is they're enabling the buybacks to continue. And, I believe that the buybacks only really started to taper off this past year. And so it's clear, at least to me, that, without the buybacks, you're not going to have a growing stock market. And you certainly can't have a growing stock market at the rates that people have become accustomed to over the last decade. And so long and the short of what I'm trying to tell you is that under normal circumstances, what the Fed is doing, would turbocharge the stock market. This is, like I said, it's a blank check. It is as much money as needed, as much debt is issued, the Fed will buy it up. And so if we're having QE infinity, that should mean that we can have, S&P infinity and Dow Jones infinity and NASDAQ infinity. But we can't. The market still closed red for the day. It was barely green for just a little while after the Fed made this announcement, and then it went right back down to red. And why is that? Well, it's because of, I guess you could say, the Wu flu. Because perhaps, in light of the Wu flu, markets understand that just throwing more money at the stock market is not going to change anything. If the underlying economy, which the stock market is loosely connected to, even though it is so far detached, or at least it was, being 158% market cap to GDP at its peak, the market was clearly detached from the underlying economy. But there's still some tenuous connection there. And with all this Wu flu stuff, essentially bringing the global economy to a halt, certainly bringing the U.S. economy to a halt, there's very little production going on in the U.S., it still doesn't make sense to buy stocks because, we have not seen the worst of this yet. The worst is yet to come. So with all that, not only uncertainty about, how things will end up after, at the end of it, but rather the certainty that things will get much worse, who is going to buy? Even with QE infinity, it seems, at least from what I understand, that corporate America is still not in good enough shape, even with all that, to keep up to restart the buyback spree, because they're going to Congress with the tail between their legs, begging for bailouts. Every single company, that's on Wall Street, that's traded on Wall Street, I should say, they're begging for money because they can't even keep their doors open. And, it's not because necessarily the interest rate is too high. The interest rate is rising because companies could not pay even at the absurdly low rate that was being asked. And the reason, as I alluded to before, is because, they don't have the cash flow. They have so much debt that they can't even, with this pullback in the economy, they do not have the bare minimum to service this debt at any interest rate. And so, the only thing that I can see that would save corporate America at this point and stop the bleeding in the stock market is if the Fed bids corporate bonds all the way into negative territory. Okay, we need negative interest rates on corporate bonds to stop corporate America from going bankrupt, because that is it right now. They have no cash flow. These companies are insolvent. The whole country is going to go bankrupt, as it should, in my opinion. But if I'm sitting at the Fed right now, that's the only option that I see available to me. And Powell seemed thankfully, to his credit, seemed pretty opposed to negative interest rates. But in this, environment, I don't see any option. If they're truly serious about saying, hey, whatever it takes to sustain the expansion, even though the expansion is over now, whatever it takes to, prevent total collapse of, the stock market, of the U.S. economy, of, the U.S. global order. We need not just negative interest rates on government bonds, to enable the U.S. government to just keep, sending checks directly to people, which I haven't gotten yet, but, which, by the way, would cost about $4 trillion a year if you do, if you go with Yang's $1,000 a month. Now there's a lot of people calling for more money than that. And I guess at this point, we should just get into it. But this money printing scheme of just, printing money and sending people checks, as I've explained in the past, is not going to do anything to, alleviate the supply side shock. People are not producing things. People are confined to their homes, and so production has fallen off a cliff. The key to an economy is producing things that people can use. That's what you do in an economy. If you're a farmer, you produce food for people to eat. If you are a tailor, you produce clothing. If you are a cobbler, you produce shoes. If you are an automaker, you produce cars. If you're sitting in your house doing nothing, you are producing nothing. And printing people green pieces of paper does not change that. Money, just sort of manipulates the demand side. It redistributes demand, and it puts, if you print money and put it in the hands of working people, you're sort of you're speeding things up. You're getting people to spend more of the national wealth. You're increasing consumption, in other words, because you're taking people who are going to consume more of their income and you're giving them more money to spend, and so consumption will rise. But we're in a point to where there's not enough stuff for all the consumers that there are, for all the consumption that exists right now to satisfy that demand. And so by giving people more money, when there's no food on the shelves, when when we don't have things to buy, is not going to make anybody's lives better. All you're going to do at best is bid prices higher and create inflation. The one, I guess, upside, the one, the one more obvious positive thing about printing people money is that, at least they can pay their rent now, and at least they can pay their electric bill. And in reality, as cruel as it might sound, you're not doing those people any good by paying the rent for now. I guess you could make an argument that from a health perspective, it makes sense that you just want to keep people in those homes for as long as possible, wherever they are, wherever they happen to be. You just want them to stay home. And so, hey, if you can pay people's rent through inflation, that's A-okay, because you don't want them going out on the streets and trying to find some other place to live. But when all is said and done, when the crisis is over, and let's say you stop paying people's rent, you're going to have a total collapse in the housing market, because suddenly you're going to have people who are living in areas where they can't find a job, and so they're going to have to leave that area and vacate the property that they've been occupying, either the place that they own or a place that they've been renting. And then if there are people leaving that area, well then, real estate's going to crash there, which should happen. But my point is that printing them money so that they could pay their rent in the short term, in the long run, is not going to have any positive effect. It's not going to help them stay in their homes, because, they will need to eventually provide for themselves. They will need to be able to pay their own rent. They will need to be able to find a job somewhere, because the economy is going to be fundamentally changed after this. Everyone who was working in restaurants, for example, before this whole crisis hit, is not going to go back to working in that same restaurant necessarily when the crisis abates. A lot of those restaurants are going to close and never reopen. Lots of other places are going to close and never reopen. And there will have to be new businesses that spring up and take advantage of that, of those labor resources that have been freed up by, the bankruptcy of other companies that were unsustainable. And so by subsidizing the unemployment of these people to such a great extent, you are in essence delaying that and preventing the economy from adjusting. And so, therefore, the effect is to keep rents artificially high. If you do nothing in this situation, landlords are going to find very quickly that a good chunk, let's say most in some cases, of their tenants cannot pay. They cannot pay them what they had been paying. So what is going to be the result of that? Well, the landlord knows that if he evicts everybody, well, then he will be making no money. Okay, he will not take in any revenue from that building or from that house or whatever it is that he owns. So the response of the landlord then, if he's smart, it will be to try and get as much money as possible. And so he will lower the rent for these people to try and keep as many tenants as possible, because he knows that, with everything being down right now anyway, nobody else is going to, or at least it's going to be very difficult for him to find somebody who will move in and pay a higher rent. And so the real estate market should adjust even in the short term. The landlords have an incentive here to try and help people pay their rent, to pay whatever they can. And then after the crisis is over, either those people will move away and find better jobs that pay more, or they will go back to their old jobs, and let's say that the same demand for housing in that area exists as there did before the crisis, and then what that means is that rents will go back up. Now, in addition to all this, which is I guess a rather esoteric economic argument that I shouldn't have gotten into because it probably bored a lot of people and I probably lost a lot of folks, but beyond this, the actual cost, if you said, hey, everybody who's being affected by this, we're going to pay your rent, the actual cost of this would be many, many, many trillions that I cannot calculate at this point. And so the Fed would be printing money and creating inflation in the general economy, because don't get me wrong, that is what they would be doing. This is very different from printing money and giving it to banks and then the bankers stick it in their back pocket and never spend it. That doesn't create really any inflation, except inflation maybe in private jets and in yachts and things that bankers would buy. But generally bankers, they invest their money. They're not going to spend it on consumer goods. But if you have all this money flowing to the landlords, and the landlords are sopping it up, well, the landlords are doing great because they're making just as much money as they did before this whole economic crash, and so they will become relatively richer because everyone else in the economy, their income has probably fallen substantially, but the landlords, their income has stayed the same. So this will be a redistribution of wealth essentially from the general populace to the landlords. This will be wage and price supports for landlords. It doesn't make sense for the cost of housing to stay the same like that, and it would create a lot of problems. So let's leave that aside, because I don't think that, I think we could get there eventually because it is such a basic need. So there is a reason why I address that, even though that's not really what they've been debating in Congress. Because in Congress, what they've been debating, as I've been talking about, is just sending people money directly. And this, of course, would be full Venezuela. That would be where we would be at this point. America would become Venezuela. Because this is pretty much what Venezuela did. Even if they didn't send people cash directly, they at least gave them very generous social services paid for by printing money. And so, what they did was, full helicopter money. It is being spread evenly throughout the economy, which again is the worst thing you can do for inflation because you are, bidding up prices in the economy evenly. If you just print money and put it in the stock market, the only price you're affecting really is the stock market, and then you're affecting the price of things that people who benefit from a rise in the stock market will spend their money on. So let's say housing in Florida. So people, their 401ks go up quite a bit because stocks are being inflated by Federal Reserve money, and they now can afford a bigger, nicer house and outbid all the regular people who live in Florida, where I am, and drive up our real estate prices. That's one effect in the real economy to where you see more inflation. But generally, especially like I say, within consumer prices, with food, with housing in much of the country, you're not going to see a massive rise in the price. But if you print money and give it directly to consumers, well, then consumer goods are where you're going to see the inflation show up, because that's where all of this newly created money is flowing into. And so what does that lead to? Massive inflation. I don't necessarily want to use the term hyperinflation because I can't predict that. Hyperinflation is a pretty unique circumstance, but it has happened, always in cases like this, to where you just print money and you give it to consumers. And this is what the Senate has been debating. The Republicans' version of this bill has been, of their stimulus bill, has been, it leans more towards corporate America. And their idea is that, well, if we support the corporations, then they'll keep people on staff and they won't lose their jobs, and so we won't need to give as much money to ordinary people. And the Democrats are saying, basically, we want, magic money tree, universal basic income. They have all become Andrew Yang suddenly, which is very strange, considering Andrew Yang didn't get that much play during the Democratic primary. He wasn't a front runner at any point, and he certainly didn't seem to be well liked by the establishment. But they've all taken to his idea pretty well, even the Republicans to a great extent, except they want it to be a one-time thing, and the Democrats are pushing this to be more of a monthly thing. The Democrat leadership, though, is taking a little bit different tact. I don't think they're going so much for the UBI. They're going more for old-school union-type policies of, we want to increase collective bargaining and, other really blue-pilled crap like that. But to be honest, as an experiment and to let things burn more quickly, I almost, even though it will cause great personal harm to me if this happens, I almost want to see the Democrats kind of prevail in getting the Republicans to put up a bill that is going to be more evenly distributed when it comes to the printing of money. I almost want to see the helicopter money really see them go full steam in that direction and really, stake everything on that. And that's just because really I feel like there's such hubris in the American economic system of people who scoff at those of us who think that inflation, is a real possibility that could ever happen, who think that, the dollar could ever be dethroned. I almost, it's sadism, I know, but, and it's also kind of masochism because I benefit from the dollar being on top because I'm an American, I import, cheap foreign goods thanks to the dollar's strength. But it's just I want to see these people proved wrong so bad, and I know that they would be if the U.S. pursued a similar policy to these other countries, to the Weimar Republic, to Zimbabwe, to Venezuela, to Argentina. And, I've never been one of the big, guys who was really worried about inflation. I understand why QE did not create inflation, and so that's why I've never really been, worried about that. I knew that, very specific circumstances would create inflation in this country, and that would be helicopter money. But now we're on the precipice of that, and for the first time, I actually caught myself looking online to buy, precious metals, which I've never considered that. I'm not that guy. I'm not the go buy gold guy. Buy gold, and use my link. I wouldn't do that. But I look at this stuff going on now, and I say, hey, this is the time when you want to actually have precious metals. I thought we would have more notice. I thought that I would, be able to get in. Now I don't have much money to begin with anyway, so if my dollars get inflated away, oh well. But still, to see that we're on the precipice of what could be, the total destruction of the dollar and thus the United States, because make no mistake, the U.S. would not survive this. I don't know what America looks like after the demise of the U.S. government, but I don't think that you're going to put Humpty Dumpty back together again if you smash this thing into a million pieces. America's coming apart at the seams as it is. The United States is far from one nation under God indivisible. We're quite divided. And so if there is a political and economic collapse, well, if there's an economic collapse, which is already happening, which then leads into a political collapse, which is likely based on the way things are going, the new political order will look quite different. But, for now we're getting ahead of ourselves. I'm going to wait and see, what direction this collapse goes. Again, if there is no helicopter money, if there is no relief for consumers, I do not expect there to be a total collapse of the dollar, and so therefore a collapse of the United States becomes less likely. Now, then again, just with a regular economic collapse, or a really, really bad economic collapse in this case, that could push social cohesion, or the lack thereof, to its limits, and break America apart anyway. But that's a much more that's a much less likely route. It's going to take a lot more pain, and force to break it that way. Whereas in the case of a dollar collapse, the political system would unravel all by its own. It wouldn't have to be broken by the people themselves. The political collapse, would happen. It would disintegrate on its own, and then the people would build a new political order. So with that said, I will continue to monitor developments in Congress to see where this bill is going. And of course, I didn't even talk about the president's press conference today. I stayed, I postponed the recording of this to see if anything interesting came out. There really wasn't anything interesting. It was a bit of William Barr talking about, hey, don't hoard medical equipment or else we're going to come and get you and steal your private property, and other authoritarian nonsense. But that's what you kind of expect at this point from economic illiterates. So with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.